Hi, this is Antoine Harris with Platinum Bridge Wealth Strategies, and we've had a very volatile start to the year. You've seen headlines around the Federal Reserve, around Omicron, around inflation. It's caused a lot of volatility. I've gone through tons of data. I wanted to give you an update on what I'm seeing, what I'm thinking, and offer you some perspective. Hopefully it's helpful. The current inflation rate, as we've seen, the last print is over 7%. This is extremely high. There are many reasons for this higher inflation. I'm not going to get into all the details, but net, from everything that I'm seeing, everything that I'm reading, we're anticipating inflation to kind of settle in at around 2.5% to 3% toward the middle to the latter part of 2022. In that environment, the Federal Reserve will have to increase rates, but they may not have to increase rates as dramatically as the market may be pricing in. We'll see how this all plays out, but we're starting from extremely low interest rates. So the Fed controls the Fed funds rate. This is 2019. This is July 2019. We're at 2.42%. We're now basically at zero. So even if the Fed raises rates 4 times in 2022, we'd be at 1%, which is still historically very low. It's even lower than where we were right before the pandemic started, January, February 2020. So even with 4 rate hikes, we're still below where we were entering the pandemic. This is still an extremely accommodative environment for stocks. What's causing market volatility is just all the uncertainty. You're seeing headlines around what the Fed's going to do, but when you kind of take a step back and get some perspective on everything, it presents a different story. So we'll see what happens eventually. I don't have a crystal ball, but I think the headlines are panicking markets a little bit here in the short term, and hopefully that dissipates as we go throughout 2022. So if you're a client of mine, you've heard me say that the whole prospect of having 60% of your portfolio in stock and 40% of your portfolio in bonds, which has been a standard middle of the road portfolio for the last 50 years, is that whole concept is is being challenged in this particular environment. So the thing to know is that there's an inverse relationship between interest rates and the value of bonds. When rates come down, bonds go up. When rates go up, bonds go down. So the last 40 years, this is the 10-year treasury rate, interest rates have been coming down systematically for 40 years. That's been a very favorable environment for bonds. So if the stocks come under pressure, the bonds are there to support the stocks in that environment. What we're seeing now is that with the prospect of rates increasing, this is since 2020, rates have been going up. In this environment, the bonds are losing value. At the same time, the stocks are under pressure because of the prospect of rising rates and inflation and what the Fed is doing, et cetera. So simultaneously, you're having bonds and stocks under pressure at the same time. So what I've been saying for well over a year is that we need to take a different bite at the apple by adding different types of investments to the portfolio, alternative investments that move neither with stocks nor with bonds and promotes additional diversification with the portfolios. And we've been doing that for well over a year. The federal debt is over $28 trillion, which is huge. You see this trajectory here. There's a lot of debt on the balance sheet. It costs a lot of money for our country to service that debt, to pay the interest on that debt. The interest payments are well over $562 billion for 2021. That's over $100 billion more than just 5 years ago. So if the Fed raises rates too aggressively, simultaneously, they're increasing what it costs to service that debt. The reason that's important is there's going to be pressure on the Fed to be judicious as far as how aggressively they raise these rates, because it's going to cost our country a lot of money to service that debt. We'll see how this all plays out. But what I want you to think about as an investor is not that we're raising rates, is where we end up. Where rates ultimately end up is more important. And I think there's some reasons why we could raise rates, but not overshoot and raise rates so much that it totally upsets the market for longer periods of time. In the short run, we're going to have volatility until we get more perspective on how things play out. The last thing that I'll say, there's a lot of cash on the sidelines. This is huge. There's as of November, this is the last data point that I could find. There's over $4.6 trillion in cash in money market assets on the sidelines. What that means is with inflation, even if inflation starts to rein in, if inflation settles in at around 2.5%, 3%, if you're sitting in cash, the money's losing purchasing power. Now, I'm holding some cash for some of you as my clients as I find opportunities to invest that money, but I need to find a place to put the money. And so does every other investor in this country and around the world. And with interest rates still relatively low, it's not a great environment to buy bonds. That money needs to find a home, and it usually finds a home in the stock market. So I think it's good that we're seeing some short-term corrections here. I think it's going to present some opportunities to deploy some of this capital, and hopefully throughout 2022, we start to settle in and have a more favorable outlook for the markets in general. These are my thoughts. I'll keep you apprised of what I'm seeing as things change. If you have any questions, please don't hesitate to reach out to me. This is Antoine Harris with Platinum Bridge Wealth Strategies. I'll talk to you soon.